Hi, I'm Greg Hunter. Welcome to USAWatchdog.com. With us once again, back-to-back best-selling author, James Rickards, and of course his most recent bestseller, you see it right here on screen. It's called The Death of Money, and it's the coming collapse of the international monetary system. Big claim to make on a book. He's just claiming that the international monetary system is on its way to collapsing. James Rickards, thank you so much for joining us today on USA Watchdog.
Thanks, Greg. Great to be with you.
Well, I just want to kind of get in here, back-to-back bestsellers. I mean, your first book, your other best-selling book, Currency Wars, which led up to this book. I mean, it looks like you're going to get another book contract, back-to-back bestsellers. This thing's only been out a couple of months.
Well, I'll wait to hear from my publisher, but thank you very much. That's very kind. And the interesting thing, Greg, of course, The Death of Money is a New York Times bestseller, but Currency Wars, my first book, really never went away. It's still selling very well, and thank goodness for technology. You know, you go to Amazon to buy The Death of Money, and it'll show you Currency Wars as, two for a discounted price. So both books are selling very well. Currency Wars never really faded, still sells well. The Death of Money, of course, a New York Times bestseller. Very, very pleased with that. I'm very grateful to the readers who are buying it and reading it. You know, I travel all over the world, and it's really fun because you see it in airport bookstores, from Hong Kong to Seattle. I was just up in Nashville the other day, and it was there. So it's great to see it all over the world. Thank you.
Well, I want to, it's kind of, The Death of Money is the technical reasons why this thing's going to implode. And I want to start with one of the most recent deals, and I think a reflection of the death of money, at least the death of the dollar anyway, as the world's reserve currency. A big deal, China, Russia, pipeline, energy, number one energy producer, number one energy consumer. Some people say, oh, it's not that big of a deal. My readers think it's a huge pivot to Asia.
Well, it's a very big deal, Greg, and just sort of combining the two books, actually the things that you're asking about, they're headline news today. So Gazprom, Ukraine, the political significance of natural gas, budding alliances between Russia and China, Russia creating an economic zone in Eastern Europe and Central Asia. These are actually things I talked about in my first book, Currency Wars. So in other words, if you read that book in 2011, you'll know you would certainly get advance warning of what's going on in 2014. The point of The Death of Money is I talk about these things also, but I take the story forward. So read The Death of Money today if you want to know what's going to happen 3 years from now. If you read Currency Wars in 2011, there's nothing happening now that comes as a surprise because I talked about all these things. And, CNBC was reporting today that, what's going on right now, of course, is there's this annual economic summit in St. Petersburg, Russia. And this time of year, they call it the White Nights. And the reason it's the White Nights, Nights, not with a K, because, it's light almost 24 hours a day in St. Petersburg because, it's the middle of summer, close to summer, and it's fairly far north. And it's been a very popular venue for years. It's kind of like Davos or, the Milken Institute, one of these places where the global elites gather. This year it's a little different because, the U.S. is not going and the White House has put pressure on U.S. CEOs not to go. It's kind of a joke, actually. I was in London recently and I talked to one of the largest private equity investors in the world. And he said, Jim, I want to go to Russia, but I've got deals to do. I want to buy gold mines in Siberia, et cetera. But I'm not going to do them right now because my government wouldn't be happy. In other words, real business people are ready to go to Russia and do business, but they feel it wouldn't look good from the government's perspective. But anyway, the summit's going ahead. There are a lot of attendees. And Putin said this morning that he envisions a Eurasian economic zone involving Eastern Europe, Central Asia, and Russia. And I've spoken about the ruble. The Russian ruble is nowhere near ready to be a global reserve currency, but it could be a regional reserve currency. And that's something I talk about in both my books. That was all described in Currency Wars, as I say, in 2011. So not news, not a surprise to those readers.
Oh.
Talk about the acquisition of gold by Russia and China. So it really takes the story forward.
Well, the ruble could just cut into like the yuan and all these other currencies if people just start trading them and buying. Russia saying, hey, listen, if you want to buy our oil and natural gas, you're going to have to use, rubles, which means that you won't be using dollars. This whole pipeline thing, this whole energy deal excludes the dollar, and it's pretty scary. I had Charles Nenner on, and he says, well, you and him are, a lot alike, just like John Williams. Your predictions are very similar. Your views are very similar. Consensus. I know you all don't sit around and talk to each other, You probably have in the past, but anyway, Nenner is saying that he thinks the beginning of the end of the dollar is this year as the world's reserve currency. He thinks 2014 it's going to collapse, or begin to collapse.
Yeah, yeah, Greg, I saw your interview with Charles Nenner. I haven't spoken to him, but I did see your interview. I thought it was very good. I recommend viewers have a look at that. But, the Death of Money was published in early April, but, I finished the writing really in late 2013, added a few sections as late as December 2013. But if you ask me one surprise, say, Jim, what has happened since you finished writing the book that comes as a surprise? I would say a lot of the things I talked about are happening faster than I would have expected. Things that I thought might happen in 2015, 2016, in that time frame, seem to be happening now in some ways. So, if anything, the tempo of events is faster than I expected. Some of these catastrophic outcomes, therefore, may come sooner than I wrote about. So Nana may be right. I mean, here's the thing. We're right on the precipice now. When you're on the precipice, it doesn't mean you fall off immediately, but you're going to fall off. You can see the forces in play. And what I tell clients and investors is it's not as if we're going to make some mistakes and bad things are going to happen. The mistakes have already been made. The instability is already in the system. We're just waiting for that catalyst, what I call the snowflake that starts the avalanche. When a snowflake starts an avalanche, you don't worry about the snowflakes. You worry about the fact that the snow is unstable. It was just waiting to collapse. And that's the way the system is now. The instability is built in. We're just waiting for a catalyst, and people ask me all the time, well, what could it be, And my answer is technically it doesn't matter because it will be something. Now, it could be a failure to deliver physical gold. It could be an MF Global type of financial failure. It could be a suicide. It could be a natural disaster. It could be a lot of things. But the thing investors need to understand is the catalyst doesn't matter. It's coming, and the instability is already there, and the system will collapse. So, I'm kind of sticking to my view that this could be a year or 2 years out, but Nenner may be right. It may be coming sooner than we think. I'm certainly seeing evidence of that in the kinds of things you mentioned, Greg, in terms of Russia and China.
Well, if you take a look at what's going on in the gold market, lots of manipulation. Now German TV is out with a TV show talking about it's becoming mainstream. It's no longer off on the the periphery and it's not manipulated. There's no manipulation, and now it's pretty much been revealed there is a massive manipulation, a big fine at one of the UK banks, Barclays, for manipulation for 2012. When is the manipulation going to end?
Well, it will end when there's a kind of physical shortage gets to the point that someone fails to deliver, at which point there'll be a buying panic. There also could be a buying panic, or what some people call a demand shock coming from China. Let me talk about that a little bit. By the way, one of the things I hope sets me apart from a lot of other commentators in the space is I don't engage in speculation. I provide facts. I provide analysis. Sometimes there's logical inference from the facts that we know, and I label it as such. I say this is inference. I don't have a hard fact on this. But if you look at my book, The Death of Money, it has 300 footnotes, actually endnotes that come at the end, and 30 pages of sources. So I don't put anything out there that I can't document. But one of the things I say about the gold manipulation, it's so obvious. If I were the manipulator, I would actually be embarrassed at this point, because you're exactly right. The manipulation is obvious. The evidence is coming in from all directions. Some of it's statistical. Some of it's hard forensic evidence. Some of it's anecdotal. Some of it's by inference. But if you put it all together, there's no question about it. And it's not new. This goes back to the 1970s. Now, I've often pointed out that between 1950 and 1970, the United States lost 11,000 tons of gold. We had 20,000 tons in 1950. We had 9,000 tons in 1970. Where did the 11,000 tons go? Well, it went to our trading partners, roughly round numbers, 3,000 to Germany, 2,000 to Italy, 2,000 to France, 500 to Netherlands, Japan. Our trading partners got the gold under the old Bretton Woods system. That was ended in 1971. But by 1980, the United States was down to about 8,000 tons, which is where we are today, a little bit more than that. But that amount of gold has remained constant. The U.S. has not sold any significant amount of gold since 1980. Well, what happened to the 1,000 tons between 1970 and 1980? 1950 and 1970 or 71 is easy to understand. But what happened to that 1,000 tons of gold that the United States lost between 1970 and 1980. Well, that was dumped on the market to suppress the price in the late 1970s. And I discovered documents from the Ford Library that were classified at the time, but have been declassified since because, it's been 35 years. So you have to keep going back to these presidential libraries and other archives to find documents that used to be impossible to get because, as I say, they were classified, but are now public. But I found letters between President Ford and the Chancellor of Germany and other internal memos among Arthur Burns and President Ford and others saying we need to dump gold to suppress the prices. It's all in my book. It's in Chapter 9 and Chapter 11 of The Death of Money. So there's clear documentary evidence. There's much more recent evidence. Some of it was dug out by Gatta and others. And there are statistical studies. There's one coming out from two professors at the New York University Stern School of Business. Now, that study has been talked about, has not been published yet. The reason it hasn't been published is interesting, is because they've provided it to the plaintiffs, the litigators, in the gold price manipulation cases. So, which, makes sense because you have to work on that. But I've seen other statistical studies privately from chief economists at major, multi-billion-dollar hedge funds. If you look at COMEX trading, after-hours trading over a 10-year period, what you'll see is that, and they should be about the same. Anyone who knows anything about markets or statistics would say that the COMEX and the after-hours, you can have daily volatility, daily fluctuations, but over 10 years they have to be the same. They're not. If you just bought and sold COMEX for 10 years, you would have lost almost all of your money. If you bought and sold the aftermarket for 10 years, you would have made multiples of what gold actually did. And so that's clear-cut statistical evidence of manipulation in the COMEX, basically slamming the close. So you look at the BIS, this is the Bank for International Settlements in Basel, Switzerland. That's the clubhouse for central bankers. Look at the footnotes to their financial statements. They say that they transact in the gold market on behalf of central banks and commercial banks. So, as I said, we have legal, statistical, forensic, and other kinds of evidence. The manipulation is clear. Now, your other question, when will it end? It'll end when there's a physical shortage that pops up somewhere or a short squeeze. Now, I talked to a very prominent gold executive in Switzerland. He was kind of funny. He said, Jim, I've never seen a market that was more ripe or more set up for a short squeeze. But he said in the old days, he was talking about the 70s, I would have called up UBS and Deutsche Bank. We would have gone in and, slammed the market and squeezed the shorts. He said, you can't do that now because there are too many cops on the beat, too many regulators and lawsuits and other sources of information. So what he was talking about was completely illegal, by the way, but kind of having fun with it in the sense that he said, we could do this today, but, JP Morgan has had $30 billion of fines, penalties, legal and compliance costs in the last several years. So I think they've had enough fun with the regulators, so they're not really going to go out and do this. But the point was that technically it was set up for that. Now, we're going to get a possible demand shock coming from China and very large demand coming from India. Let me explain those two cases. I'll do India first. We have a brand new government in India. They're going to repeal the import tax on gold. The wedding season is coming up, and the Indian rupee is getting stronger. Now, put all that together. So let's say you're an Indian and you want to buy some gold. Well, if your currency is stronger, that means you get more gold for your rupees. The wedding season is a traditional seasonal factor. The thing that was standing in the way of Indian demand was the import tax, but they're going to get rid of that. One of the reasons was their gold fabrication industry moved to Pakistan. Somehow the Indian government lost sight of the fact that when people import gold, they use it to make jewelry. And if you made the imports too expensive, the jewelry manufacturers went to Pakistan. So they'll get that value added back. So India is technically set up for a very large surge in demand in the fourth quarter. Now over to China. And this is one of the things I said are happening faster than I thought. The China credit collapse story is happening in real time. Again, I said this might be a 2015 event, but it looks like it's happening now. Defaults are piling up. We're seeing money riots. We're seeing people march down to the banks with their wealth management products trying to get their money back, only to be told by the banks that those are not, quote, bank products. They're private products that happen to be sold in banks. Well, that's a distinction that's probably lost on the average Chinese investor. And those banks are going to have to sell assets to kind of raise cash. At the end of the day, the government can bail them out. The Chinese government has $4 trillion in reserves, so they can bail out the banking system. But there'll be a lot of distress in the short run. Now, look at what a Chinese investor can do. They cannot buy foreign stocks and bonds because China has a closed capital account. They don't want to buy Chinese stocks because the Shanghai stock market has been crashing. It's been a lousy investment. They don't want to put their money in the bank because the bank pays them, almost nothing. They have been piling their money into real estate, and these kind of CDOs, what they call wealth management products. But that's exactly the sector that's collapsing now that they want to get out of. So if they can't buy foreign stocks, domestic stocks, don't want to put their money in the bank and are getting out of real estate, what's left? The answer is gold. And I talked to the head commodities trader globally of one of the largest banks in the world. He agrees with this analysis, and he sees a demand shock coming from China. So you got shortage of physical supply, demand coming from China, demand coming from India, et cetera. This is a recipe, if you will, for either a short squeeze or somebody somewhere just not being able to deliver. Once that becomes apparent, then you could see the scramble to buy gold. It's going on anyway, but it's starting to accelerate. So that's the thing that will take down the manipulation, because the manipulation only works if people either are not aware of it, don't understand it, or think it's bigger than they are. But once the market sort of prevails over the manipulators, then watch out.
Well, then it looks like, the timing of this looks like, is it also speeding up? You said that a lot of things that you talked about in your book that may be in 2015 and 16 may be speeding up now. Incidentally, that's the consensus of readers on my site. I have some smart people reading the site, and they say, it looks like to me it's going to be faster than what people think, that maybe the dollar's already falling out of bed with the China-Russia pipeline deal. You have a big election in India. It looks like they're going to go back to importing gold. And so you're saying that could this manipulation end in 2014?
Well, it's certainly possible. Here's the way I would put it, Greg. I'm extremely critical of Fed models and Wall Street models, and not just critical, but they're actually kind of false science. The stochastic general equilibrium models that the Fed uses, the value at risk models that Wall Street uses, they're not just kind of funky or wrong. It's just bad science. It's junk science. And I talk about that in both my books, Currency Wars and The Death of Money. Now, here's the thing. I have my own models. I use complexity theory. But one of the things I say is that you have to be very humble about what you can do with models. If you get the right model, obviously that's a lot better than having the wrong model. But even then, you say, it's not a crystal ball. I don't have perfect clarity. I just have a little improved way of thinking about things. But to be true to the way I analyze things, one of the things you learn in complexity theory is that, you don't know the exact timing of events. You can see them coming in the sense of the instability in the system, what's called the scale of the system, how complex systems collapse. When you get all that data right and get the model right, you can see the collapse coming, absolutely. But the timing is the one thing you can't know. It's one thing that people don't like about it. They want me to call them up at 3:00 in the afternoon the day before the system collapses, and so they can sell their stocks and buy gold. And I say, look, it doesn't work that way. I'm not going to know the day before, and neither will you. But I do know that you ought to get out of stocks now, into gold now, so you're positioned for when it does happen. But one of the things you learn is that the timing is always a surprise. I'll give you a very concrete example. There was a lot of buzz last January. Gordon Chang, who is an excellent analyst of China, and I follow what he does, and I think his work's very good. He said in early January that there was a corporate bond that was likely to default at the end of January. And I got a lot of calls saying, hey, Jim, is this the snowflake that causes the avalanche? Is this the beginning of the collapse? And I said, almost certainly not. And the reason is, if you can see it coming 30 days in advance, that's not the thing that takes the system down, because you got plenty of time to fix it. And that's what I said at the time. I said, yeah, there'll be a default, but we know about it, a month in advance. So they're going to paper it over, and that won't be the thing that takes us down. It's the thing you don't see coming. And when it happens, things happen much more quickly than investors expect. What'll happen in gold is, it'll chug along, it's volatile, it'll go down a little, up a little, and all of a sudden, boom, one day it'll be up, $100 an ounce, and then the next day it'll be up, $200 an ounce, and then everyone will be on TV saying, oh, it's a bubble, or this is a head fake, or said, boom, next day, $300 an ounce. Before you know it, it'll be up $1,000 an ounce. And then people say, oh, gee, I better get some gold. And they'll find out that they can't get it because, the big guys will get it. So central banks, sovereign wealth funds, large multi-billion-dollar hedge funds, they'll be able to get the gold. But the typical investor, you're going to run down to the coin shop. They'll be sold out. You're going to go online, call the U.S. Mint. They'll say, sorry, we're not shipping. You're going to find that you can't get it because the whole thing is set up technically for a massive shortage of floating supply. That's what's going on. So, again, these things do happen very quickly. Could it happen late this year? Possible. I'm not making a hard and fast call on that, but I am saying it's definitely possible. But if you put it out over a 2-year horizon, this is definitely coming. The time to get gold and get some liquidity and position yourself is right now.
Well, let's talk about Belgium and all these bonds. I know, as a, you're a banking expert. You're one of your things that you in your feather in your hat is you are a investment banker, and you must be looking at the buying of bonds, treasuries in Belgium, going, huh? Say what? I mean, it's a $480 billion GDP, and I think they're holding now 340 or something billion in U.S. treasuries. They bought 140 billion. Paul Craig Roberts is saying, where'd the money come from in the last few months? Other people like Carl Denninger are saying, well, they're supposed to account for that on the books, and they don't really do it, so it's not really proven out. What do you say about all this? The treasuries owned by Belgium, a tiny country, but it's the heart of the euro, or the EU.
Sure. One thing we can be sure of, it's the buying is not coming from Belgium. It shows up as Belgium on the TIC report. This is the TIC report is the Treasury report that comes out periodically showing foreign holdings of U.S. government securities. This report actually was created by a friend of mine, Tony Fraudo, when he was at the Treasury a few years ago. This report hasn't been out for a long time. They've been doing it for, I think, 7 or 8 years. I'm sorry, a little bit longer than that, maybe 10 years, but it's a fairly recent innovation. But here's the thing with that. You mentioned my background. For 10 years, I was chief lawyer and chief credit officer of one of the primary dealers, one of the banks that are so-called primary dealers. What's a primary dealer? Well, when the Fed engages in money operations, what they call market operations, they buy or sell U.S. government securities to create money. When the Fed wants to print money, they buy securities and they pay for the securities with money they just printed. When they want to reduce the money supply, they sell securities and they get paid for it, and that money just disappears down a black hole. So these open market operations are how the Fed increases or decreases the money supply. Of course, since 2008, they've been doing nothing but increasing the money supply by, close to $4 trillion. Well, when they buy or sell securities, who do they buy or sell with? In other words, who are the counterparties? Well, the Fed has an approved list. It's a very small list. There are only about 20 names on the list. My former firm was one of those names, and being on that list is what makes you a primary dealer. So the Fed was our customer, in other words. We dealt with them. I met regularly at the Fed, met with top Fed officials. I was down at the Federal Reserve Bank in New York numerous times. So I'm very kind of intimately familiar with how the Fed does this. Now, people say, well, it's not Belgium. Who is it? Well, what's in Belgium? Well, you have Euroclear. Euroclear is a major custodian and clearinghouse for all kinds of securities. So if a third party, someone else, was buying those securities, they could hold them in custody at Euroclear, and that would show up as Belgian ownership, even though the country of Belgium is not the owner. And also, as you point out, Greg, Belgium is the headquarters of the European Union in Brussels. So who could the buyer be? We don't know, and again, I don't want to guess. I don't believe in that kind of speculation. I like to stick to the facts. But we do know the following. In the crisis in 2009, when U.S. banks were on the verge of collapse and European banks were on the verge of collapse, both central banks, the Federal Reserve and the European Central Bank, were busy bailing out their banking system. Well, the U.S. could just print money, but the European Central Bank had a problem, which is a lot of their banks under their jurisdiction, had U.S. dollar liabilities to U.S. money market funds. Now, the problem there is the European Central Bank can print euros, but they can't print dollars. So if you're trying to bail out a bank that needs dollars and you print euros, where are you going to get the dollars? Well, the answer is that the Fed and the ECB engaged in the swap arrangement. The Fed printed dollars, the European Central Bank printed euros, and then they swapped them. So this gave the European Central Bank dollars that they could use to bail out their banks. Now, this was not disclosed at the time. The only reason we know anything about it was because Dodd-Frank, believe it or not, had some provisions requiring a little bit of transparency. These swaps were in the tens of trillions of dollars. Trillions, not billions. They were huge, and they're still in place. So could the Fed and the European Central Bank be engaged in a swap where the European Central Bank gets dollars from the Fed, goes out through Euroclear on an anonymous basis, and buys the U.S. Treasuries? That is possible. I don't know for a fact if that's what happens, if that's what has happened, but it does seem the most likely scenario because who else?
And that wouldn't show up on the Fed's the books on what they have to report, would it?
Correct. That's correct. That's correct. When people say the Fed's buying them, the Fed might be financing them, but the Fed's not buying them. The European Central Bank could be buying them, but the Fed could be giving the European Central Bank the dollars they need to buy them. And so in effect, indirectly, the Fed's financing the purchase of treasuries, but they have an indirect buyer through the European Central Bank. So that would not show up on the Fed balance sheet. By the way, these swaps I talked about, where the two central banks swap currencies, those are off balance sheet. Those are not publicly reported by the Fed. We don't know how big they are. We know they exist because of Dodd-Frank. We know that the magnitude is in the tens of trillions, possibly more. But we don't know the size because the Fed does not disclose that. The European Central Bank does not disclose it. And so they get off balance sheet dollars. And then if you have Euroclear as a nominal buyer, we don't even know, or custodian, let's say, that shows up as Belgium on a tick report, and we don't even know who the real buyer is. So this is, by the way, the same thing goes on with the Bank for International Settlements when it comes to gold. As I say, we can dig out a footnote in the BIS financial statements, but we don't know who's actually doing it. So Bank for International Settlements, Euroclear, European Central Bank, these are all backdoor channels the Fed can use to manipulate the dollar and manipulate gold, and they are doing it. The evidence is clear.
And the reason why that these bonds are showing up in Belgium through Euroclear, that is probably the buyer. They're doing it because nobody's buying the treasuries. People are dumping the treasuries. I mean, they're doing it because
that's correct. That's correct. Remember,
are they desperate? I mean, it sounds crazy to me.
Well, it's not crazy. When your system's collapsing, you get desperate. Desperate people do desperate things. Now, here's the thing: Euroclear is not the buyer; they're the custodian. But that's so it shows up as Belgium on the report. We're speculating that Euroclear is the custodian because that's the only entity there. This is not coming from Belgian banks. It's not coming from Belgian dentists.
There's no exposure to Belgium.
Well, as I say, the tick report lists the buyer by country, which is really just the source. It's where the source of the money is coming from, but it does not identify the buyer by name. We can be certain it's not Belgium because they don't have that much money. The economy's not that big. And it's not anyone in Belgium for the same reason. So it's a third party. We're pretty sure it's not China and not Russia, not Saudi Arabia for other reasons. And so it is likely the European Central Bank, and they would get the dollars from the Fed under these swap arrangements as we just discussed. Now here's the thing. Why is this going on? Because others are dumping. We know that Russia has dumped hundreds of billions of dollars of treasury securities. China can't dump most of what they have, but at the margin, they're not buying any more. Because they want to buy other assets, gold, particularly, but they're investing a lot in Europe and buying mining, natural resource assets around the world. By the way, there's another buyer out there if the Fed gets desperate. See, here's the problem, Greg. There's a huge struggle going on right now inside the Fed. Maybe that's a subject for another interview because that's a fairly long discussion between the hawks and the doves. The doves believe that there's really no limit to the Fed balance sheet. They're at $4 trillion. They could go to $8 trillion. They could go to $12 trillion. Whatever it takes. They could just keep printing money. The hawks have a different view. They say a couple things. Number one, there may not be a legal limit, which there isn't, but there's a confidence limit. At some point, you could collapse confidence in the dollar. The Fed is close to that limit and therefore probably needs to, taper the QE and maybe even reduce the assets on the balance sheet at this point. So that's what's going on. There's a struggle. Right now, we have a very hawkish FOMC for a couple of reasons. The FOMC, Federal Open Market Committee, they're the ones who determine these policies. Now, it's supposed to be 7 members of the governors of the Federal Reserve Board and 4 regional reserve bank presidents. So a total of 11 members, 7 and 4. Right now, there are 3 vacancies on the Federal Reserve Board. So they only have 4 out of the 7 votes. So when they show up for a meeting, it's not 11 people, it's 8 people, 4 governors and 4 reserve bank presidents. Historically, the Reserve Bank presidents have been much more hawkish than the governors. So instead of coming in 7-4, you come in 4-4. You're outnumbered by the hawks. And among the presidents, we have 2 of the most hawkish members of all right now, Charles Plosser of Philadelphia and Richard Fisher of Dallas. So this is an extremely hawkish board. And remember, Yellen is new on the job. She may be chairwoman, but she's not a dictator. She needs to build consensus. When you're the new kid on the block, you don't walk into a board meeting and blow up policy. It takes months or even a year or more to form that consensus. So right now you have a hawkish board that wants to back away. So the Fed is looking around the world for other, I call them buyers of last resort. Right now they seem to be coming from Europe, probably the European Central Bank. But don't forget the U.S. banking system itself. In the 1950s, a typical bank balance sheet, well, just the consolidated bank balance sheet of all the banks in the United States, had more than 50% of their assets in Treasury securities. Today, that number is less than 10%. So there's a lot of headroom between 10% and 50%. In other words, they can force the banks to buy the bonds. In 2008, the banks were bailed out.
This can go on for a while.
It can go on for a while, but we'll start to see it in different ways. We'll see when these tick reports come out, we'll see Russia dumping. We'll see other, maybe Saudi Arabia and others dumping. We'll see, Belgium buying. Now, you won't see, if they force the banks to buy, which they can do, you won't see that on the tick report because those are only foreign buyers. It will show up in FDIC and OCC, Office of the Control of the Currency. It will show up in other reports. I mean, this is not easy forensically. You got to look in a lot of places. You have to know how the system works. You have to really dig. But that's what I like to do. I like to stick to hard evidence and not engage in some of the, more wild speculation you read on some of these websites, et cetera. But, in 2008, the bankers said, gee, this is great. We were bailed out. We get to keep our jobs. We get to keep our bonuses. We get to keep ripping off savers and ripping off the economy. This is a really good deal for us, pay ourselves big bonuses, et cetera. But what they're gradually discovering is that there was a price to pay. It's really a deal with the devil. The price to pay is that the banks are now captive by the government. The government can shut down or break up any one of them whenever they want. And using that as a threat behind the scenes, they can force the banks to buy the bonds. So if the Fed balance sheet gets tapped out, which it is, and now we have this European mystery buyer, which maybe there's a limit on that, they can always turn to the banks. So this can go on for a long time. But the problem is, at what point do investors, citizens, countries around the world just say, you know what, this is obviously such a game. There's obviously no way out. You sort of have the Fed has two choices, and they're both bad. If they continue the taper, which they may, they're tapering into weakness, they're going to throw the U.S. into a recession within the depression. We've been in a depression since 2007, but you can have a little bit of growth in a depression. It just means that depression just means your growth is below trend. But you can have multiple recessions in a depression, which is what we had in the Great Depression from 1929 to 1940. There were two technical recessions, 1929 to 1933 and 1937. So this could be the second recession within a depression if the Fed continues to taper. If they don't continue the taper, they pause, which is a possibility, and they increase asset purchases, maybe in 2015, people will call it QE4 or whatever, then this will be a signal to the market that the Fed has got to keep printing. And then gold's going to go up and the dollar's going to collapse because it'll be very obvious that there's no way for this game to end. So the Fed has kind of two choices: depression, hyperinflation. Good luck with that. But that's what happens when you manipulate markets. You paint yourself into a corner and there's no way out.
Shouldn't they have just said in 2008, we're going to print $6 trillion. We're going to cover all the depositors, and your bondholders, you're done. Your shareholders, sorry. We're going to save the system in terms of the depositors, and everybody's going to have to take a hit here and now. Wouldn't that have been better? Wouldn't that have been cheaper?
Absolutely better, absolutely cheaper. And by the way, you wouldn't have had to print $6 trillion or whatever the number was. You could have issued guarantees. In other words, what they should have done is just nationalized all the banks. They were all failing. They were failing sequentially. What the Fed did, they truncated the sequential failure. They said, okay, we're going to draw a line. So, Bear Stearns, Fannie Mae, Freddie Mac, Lehman, AIG, you guys fail. But Morgan Stanley, Goldman Sachs, Citi, we're going to preserve you guys. If they hadn't done that, they all would have collapsed. Goldman Sachs would have collapsed. They were bailed out. Morgan Stanley would have collapsed. They were bailed out, et cetera. So that's what the Fed did. They should have let them all fail. When I say fail, wipe out the stockholders, haircut the bondholders. But you could have guaranteed the deposits, prevented a run off the bank without printing a nickel. You don't have to print a nickel. All you have to do is expand federal deposit insurance. They could have done that, strip out the bad assets, put them in, and then IPO the clean banks, because you don't want the governments running the banks forever. You just would have had a temporary nationalization, very similar to what the government did with General Motors. That got IPO'd not long after. They could have re-IPO'd the banks, except they would have been clean banks that could have made loans to get the economy moving, and the pain on the stockholders and the bondholders would have been, you guys put money into these banks. You deserve to lose. The taxpayers and the citizens do not deserve to lose. They do not deserve to have their savings stolen through inflation. Instead, let's put the loss where it belongs, on the institutional investors and the bondholders. But the Treasury didn't want to do that, and the Fed didn't want to do that because of the cronyism. Those large institutions are their friends. These guys are all buddies. I've seen it in action. When LTCM was bailed out, long-term capital management was bailed out, one of our partners was the former vice chairman of the Federal Reserve. You don't think that kind of cronyism is always a play. But the problem is you make it worse, you make it worse. So the next collapse will be bigger than the Fed. That's the difference. When I talk about this coming collapse, people say, well, we've had these panics before, we've had these drawdowns before, and we always muddle through. Well, the answer is, yeah, we have muddled through. We muddle through in ways that make the problem worse. The next problem will be bigger than the Fed, and then so the IMF is actually going to have to bail out the United States.
James Rickards, there's the book. Another back-to-back bestseller for James Rickards. It is The Death of Money. You talk all about the coming collapse of the international monetary system. James Rickards, thank you for coming on USA Watchdog and enlightening us about the events that you have forecasted and described in your book. Thank you so much.
Thanks, Greg.